Hello everyone, this is Dr. Mihir Shah once again with another video. In this video, we are going to take up the case study problem sum that had appeared in university paper in the year November 2019 under the subject Investment Analysis and Portfolio Management, also known as IAPM. Again, a very important video for all the TYBMS SEM 5 student. So in this video, basically, we are going to go through first the question that had appeared under case study. Okay, we'll see what questions are they asking us to find, and according to that we will be giving them the most appropriate answer. So let us see what case study had appeared. Okay, it is given as a portfolio management consultant. You are approached by Mr. Puri, age 27, with an investable fund of rupees 50 lakhs. He wants to know from the following: what are the investment avenues available to him which will give him suitable return with maximum return, and what are the various types of risk. Okay, whenever you're going to solve case study, see that you'll solve the case study in some parts. First part will always be note down the characteristic of the investor. Number one, age is 27 years, is a young investor. Okay, next is investable funds, which is 50 lakhs, and risk appetite is high and can take more risk for higher return. Objectives, next is objective of investor. Okay, always note down the objectives. First is maximum return, second is capital appreciation, third is diversification of portfolio, fourth is liquidity, fifth is wealth creation. Okay, so these are the objectives. So remember, in any of the case studies, these objectives remains almost similar, so you can use the same objectives in multiple case studies also. Okay, so according to his 50 lakhs and whatever he wanted, okay, this is how I had broken up his investment avenues. So equity share will be 15 lakhs, mutual fund 12 lakhs, fixed deposit 8 lakhs, bonds 7 lakhs, real estate 6 lakhs, and gold ETF is 2 lakhs. Okay, you all can go through this once. Okay, now whatever investment avenues we have suggested him, we will explain that one by one. So first is equity share. So since Mr. Puri is young and ready to take risk, a major portion can be invested in equity shares of fundamentally strong companies from diversified sector. The merits is high return potential, high liquidity. Demerits will be high market risk and returns are uncertain. Second, mutual fund 12 lakhs. Investment in mutual fund will provide diversification and professional management. They can allocate 8 lakhs and 4 lakhs in equity and hybrid. Merits are diversification of risk, professionally managed, and demerits is management will have some expenses and no direct control. Third is fixed deposit 8 lakhs to maintain safety and liquidity. A part of the fund can be invested in bank FD. Assured returns you will get, safe investment. Demerits are low return as compared to equity and no capital appreciation. For bonds and debentures 7 lakh, investment in corporate or government bond will provide stable income. So merits are regular income, transferable. Demerits limited capital growth and interest rate risk. Okay, that can if you have invested it can fall also. Next for real estate, a portion can be invested in real estate or REIT, the real estate investment trust. Okay, 6 lakhs may investment so no, but you can invest in the trust. Okay, for long term wealth creation. Tangible assets are there, hedge capital inflation, capital appreciation. Demerits may be low liquidity, high transaction cost. And lastly, gold ETFs. Okay, investment gold ETF provides safety and act as a hedge against market fluctuation. So merits are hedge against inflation, highly liquid. Demerits is no regular income and price volatility. Okay, these are the explanation of all the avenues. You can go through it once. Okay, last is conclusion. We'll show the chart of the entire investment revenue. Equity share 15 lakh, mutual fund 12 lakhs, fixed deposit 8 lakhs, bond 7, real estate 6, and gold 2 lakh. Total comes to 50 lakhs, 100%. Okay, you all can go through it once. Okay, and lastly, what are the types of risk? So risk can be classified into two types. We have systematic risk and unsystematic. Systematics are external risks affecting the entire market or economy, cannot be avoided and can only be managed. So we have market risk, interest rate risk, and inflation risk. And unsystematic risks are company based risk. The types are business risk, financial risk, and default risk. You all can go through it once. Okay, chalo. So I hope you all have noted it down. I hope you all have understood this case study. Chalo, with that we will be ending this video here. Thank you.